corporate bond defaults are skyrocketing, already surpassing the highest level in 20 years. But according to Moody's, the healing is not too far away. Brian Luke is here with more on the story.
Yeah, Mark, it's a little bit of a bad news, good news situation what we've got here in the corporate bond market. And first, the bad news is that corporate defaults are expected to skyrocket. They're going to go up to a record level, at least in the 20 years. And I'm talking about non-financial corporate bonds here. Those are going to be peaking, though. The good news, they'll be peaking in November and then coming down significantly to a little what Moody's calls a more normal level. But let's focus on the bottom rung here, this triple C corporates. I'm going to show you exactly what I'm talking about. You see that it's triple C portion. That's an ever-growing slice of that pie in terms of the investment grade setting now. Triple C's, that's the bottom rung. Next stop would be default. Now, you see the growth. I want to show you exactly, because if you look at another chart here, it's a 4-year level of triple C growth here. It's doubled from over 2 years ago. It's now 12% of the overall market. Now, Mark, when you talk about Moody's and the default and where you're at on the bottom rung, 95% of defaulters come from that bottom rung. So that's a pretty good sign that there's more companies on the fringe, really.
So if there are more on the fringe, shouldn't that point to a bad signal for the future? Not necessarily so, right?
Yeah, not necessarily, because the forecasters at Moody's, what they're focusing on is a few different things. Now, first, I want to show you what they're looking at in terms of their forecast and where we've come from in terms of this overall default rate. Now, in blue is the actual default rate. Now, in the orange, they see a steep drop in defaults coming in, and it's coming into a more normalized level, as we were saying, to about 4%. Now, a few reasons for that is that they expect fewer downgrades to upgrades. Now, right now, we're at a ratio of 2 downgrades for every upgrade in bonds. Well, back in February, that was like 10 to 1. So that's another really good sign. So secondly, the stronger liquidity profile of banks, they're being able to tap the capital markets, they're being able to refinance out of other loan debt. They also see that corporate bond spreads, now the market's really a cure-all for these high-yield issuers, because as spreads come down, that improves their balance sheet. That gives them a better idea to be able to refinance and move along. And that's what Moody's is focusing on in terms of this peak and then coming down significantly, in fact.
Bloomberg's Brian Luke. Brian, thanks so much.